Good afternoon, everybody. I'm your host, Romil Patel, and I want to do a weekly market analysis like we do every single week. Last week I did not get to do one, so it's been 2 weeks since I've done one, so I've got a lot of things to get to. I got a fundamental analysis, technical analysis. We also have older options trades that we want to look at, many of which have become 6, 7 baggers, and I also want to put on some new options trades because in this current market environment where direction just doesn't feel right, I think that the best way to go about it is using those option spreads, which we've been doing for probably the last 3 weeks or so. So looking into this market right here, one of the first things that I noticed, I'm taking this term from Peter Resnicek over at Shadow Trader. So he's the one who coined this term, and what he said is when what should happen does not happen. So what does he mean by that? When what should happen does not happen. Well, looking at the technicals, so just looking at plain old price action, nothing else, we see that there is a big gap right here on the cash index, and another big gap right here. So when what should happen does not happen. So what should happen when you have a gap? When you have a gap, you should fill that gap. And it's very logical to think that way, because if you have a gap, there's a support or there is a lack of support or resistance. Because there's a lack of support or resistance, you should get filled pretty easily. And what is support and resistance? Support and resistance lines are created because people oftentimes put their buy and sell orders right there. People put their orders to cover and short right there. That's what creates a support and resistance line. People also call it a supply and demand zone because oftentimes the market tries to go up, but it can't go up any further because it hits this resistance. It hits a supply zone where everybody puts their limit orders to get out of their buy positions, and everybody puts a limit order to get into short positions. And so that's all a support and resistance line is. Whenever you have a gap, you have a lack of those support and resistance lines, so it should fill right through. So right here, you would have expected that when it came and it tested this, when it came, tested it right here, and it bounced, that it would have filled, and that it would have filled. And this is actually just looking at the SPX cash, and the SPX cash looks at what goes on during the daytime. If we actually look inside the overnight session, we see again and again and again where it tries to come down, but then it bounces, comes down and bounces, and that shouldn't happen. It should fill the gap. And so when what should happen does not happen. Right here also, it's not filling the gap. We can actually zoom in a bit more, go in onto the 15-minute time frame, and we see it's that same thing that I've been saying over and over again, and that other people like Peter Resnicek have been saying, that when what should happen does not happen. So you would expect it came down, started to come down, came down right here. You had this ginormous gap, came down to the gap, but then it bounced. And so you'd have to ask yourself, why do you bounce on the gap? Because you would expect that if there's this big gap right here, that right here, it would have filled, right here, it would have filled, but it didn't fill. So this is the big when what should happen does not happen. What should happen is it should fill the gap and go lower. But it didn't fill the gap and go lower. So what is this essentially telling us? It's very, very bullish price action. That's all it is. At the end of the day, it's very bullish price action. So that's all I have to say going into it from a price action perspective is that we have very bullish price action because when what should happen does not happen. These gaps should be getting filled and getting filled very easily, but they are not. So with that said, I had a comment from a viewer. So Aaron made a comment and said that, could I elaborate why the SP 500 would not get above the 61.8 fib retracement? Okay, so it has gotten above it slightly, but I have to say the news did catch me off guard because I didn't think that the market would be as irrational as it was. But essentially, if we did not have this gap up open right here, where the market went higher, it would have stayed within those 61.8 fib retracement. Now I think the next resistance area is the 200-day moving average. But originally why I thought that was every time it got up to that area, it would reject. It would reject. and every single time it would go up and it would reject that area. What happened though is that we had this news that came out with Moderna, and came out and basically said that they've got a new vaccine and that that within a couple of months it should be out in the open in the public. Everybody should be able to use it in the open market, and so it was bullish for the market. Of course, I've been telling you guys for a while now that coronavirus is simply the pin that pricked the bubble. That coronavirus is not the reason the market is going down. It's simply a catalyst for it to go down. It's not the reason though. So it's a pin that pricked the bubble. So you already have a financial bubble. It's just a pin that pricked that financial bubble. Now, with that said, Moderna, I believe the ticker symbol is mRNA. So Moderna, it's coming down. It's coming down every single day. It's coming down. Why is this? Why is it coming down? Because they came out with a new vaccine. You would think that they would go up. Well, here's why I said I didn't think the market would be that irrational, but it is that irrational. With Moderna, they came out with a vaccine. It was quicker than it was expected. Nobody expected them to come out that quickly with the vaccine. But what happened then afterwards was that you had a situation where the CEO, the CFO, all the C-suite employees are selling their stock hand over fist. So the market went up on that news, gapped up right up here, and the CEO and all their buddies, the C-suite employees, are selling their stock hand over fist. And you can just search up, I think you can probably search up Moderna stock, and you'll probably be able to find that Moderna CEO sells stock. So you can just Google this, but I was actually reading this article, but Moderna CEOs and other execs have made millions on vaccine announcement. So they themselves were selling their own stocks. So clearly, if there was a vaccine, Moderna should be making a lot of money, and it isn't priced in, and so they would know that, and they wouldn't be selling their own stock, but they are. And so I find it to be very bearish. Eventually, the market did catch up. We had this big down week, but the news that the S&P went up on, the news that we had the S&P gap up on, was irrational. It should have not happened. The market should have not gone up because the Moderna news, for lack of a better word, was fake news. So with that said, I do think it would have stayed above the 61 or stayed below the 61.8 fib if it were not for that. With that said, now you still have a lot of resistance. You have 3,000 psychological. It's right at that right here. I would have to close above that and keep on going up from there and stay above that. You have right here moving averages, and there's so many moving averages right here. 200-day moving average. I think the 50 EMA too. So lots of people, institutions are the ones who are paying attention to these very long-term moving averages. 200-day, 50-day moving average and exponential moving average. They are the ones who pay attention to that. And because of that, they line up their buy orders right there. And so right now, most institutions are still bearish. But as soon as it gets above the 200-day moving average, they start to become bullish. Because that is the main moving average for them that tends to, they only want to buy stocks when they're above it, not below it. They want to short stocks that are below it. So that's what they pay attention to. Something like the 20 or 10-day moving average or exponential moving average, those move too fast for them. So they look at that, and then they look at golden crosses and death crosses. We had a death cross. That is a death cross. And they oftentimes will not start buying up until this moves up and you get a golden cross. And so this is what they oftentimes do. So that's another reason why if it does go up, it's not going to go up that quickly. And that's because there's just so much resistance. 61.8 fib retracement, okay, got above that, although I think it got above that for a terrible reason. The fundamental reason that it got above that is really bad. Moderna was clearly the vaccine's not going to come out anytime soon. And the C-suite employees knew that. They were selling stock hand over fist. So that has broken, but for an irrational reason. But then you have so much resistance after that, and you have psychological resistance after that too. And then you have the resistance that's brought on by this, which would then be this level. And you have some resistance right here. And actually, this resistance is playing out right now. So if it does go up, it's going to go very slowly, not with a lot of momentum. I do have to respect the price action, though. The price action is bullish due to the fact of what we just talked about. The when what should happen does not happen. And we're running across that situation intraday. We can see that right now, where it tries to fill the gap, cannot fill the gap. Goes up, tries to fill the gap, cannot fill the gap. And then it goes higher. So the gap that it cannot fill is the example right there that I'm saying when what should happen does not happen. What should happen is you just fill the gap very easily because the gap has no support or resistance. But when what should happen does not happen. So right there, technicals, they don't look good. Or technical short term, they look good. Long term, they don't look good. It's not healthy when this happens. When the market doesn't fill a gap, it means it's bullish short term, but long term, it creates a poor support, as many would call it. So let me clear all the drawings. We have quite a few drawings right here. So I will remove drawings. Okay, so I'm just going to draw it on the side. Poor support essentially means that the market goes up, 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 never comes down. So then when it tops out and it starts to come down for a pullback, it goes down, 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 and there's lack of support. I've talked about this before on this channel. When you have a strong support level, goes up, pulls back, fills the gap, and then goes higher, pulls back, fills the gap, and does that again and again. So now when the market tops out with an equal high, it comes down, pull back, and then when it goes lower, you are in a situation where you have lots of support, right? You have support, and so instead of just going straight up, and then with a lack of support or resistance below, it goes straight down, you actually have a situation where right here, support, right here, support. And so that's why we call that strong support right there. But the market, what's happening in the market with all the price action is short-term very bullish. The fact that the market does not fill the gaps is bullish. But long-term, that is bearish. Because when the market starts to fall, it's going to fall, and it's just going to fill the gap, it's going to fall, and it's just going to fill the gap. So it's poor support long-term. So that's what's happening right there. Fundamentally, you guys already know that. I think it's overvalued on whatever metric you want to look at it. Wilshire 5000 to gross national product. That's the most obvious way to look at it. Looking at individual companies and how their earnings are doesn't look good. The only thing that's bullish for this is that the Fed is pulling it up. Cheap money, loose monetary and fiscal policy is pulling it up. And from a perspective of breadth in the market, the S&P 500 is being pulled up by the 5 largest stocks. The 5 largest stocks in the S&P 500 are making up almost half of the S&P 500. So you're in a situation where almost half of the S&P 500 is made up of just 5 stocks. So that right there creates a situation where it's misleading. Looking at the S&P 500 is very misleading. You see the market going higher, you think everything's great. But you actually look at most stocks are actually right now, as I speak, going lower. It's just that the S&P 500 has a lot of weighting from names like Amazon and Apple and such. So they tend to go higher because of that. But I don't think, though, that it's a healthy rally because the breadth of the rally is not good. Most stocks are not rallying. Most stocks have stalled in their rally. And it's just that these big tech names are pulling it up. And the big tech names make up a large portion of the S&P. And I actually talked about this last time with the financials. So if we actually look at the financials, they have barely had a bounce. And so you're in a situation where on the financials, they bounced up, and then equal high. So this high, equal high, and then it's coming up here to test it. and I think that likely it will reject because it has rejected the last time, and the fundamentals don't look good. But you look at these other sector ETFs, you ignore tech, you ignore the sector ETF for tech is XLK. You can also look at the NASDAQ, but this is tech. And you can obviously see it's reward higher. But you ignore tech and you look at the other ones like financials, and it's clearly bearish. The balance just is not there. And actually looking back right here, we can go and we can look at a monthly chart, and long term is bearish too. Tech could not even get above its high. Right here, high, touch the high again, touch the high again, could never get above its highs. So that's long-term bearish. Small caps, we see something similar in the small caps where we can zoom in and we can see that while everybody else was making new highs, they were still right here when the market topped out. Their top was all the way back in 2018. So it's bearish across the board on the small caps and on the sectors that people don't pay attention to. It's just that the S&P 500 is made up of 5 tech names, really. Half the index is made up of just 5 names, so it's holding up a lot better. But the overall, when you look at market breadth, it looks very bearish. So with that said, how are we going to take this on? I wanted to look at the options trades that we did last time, and look into new options trades that we want to do this time. Because I think the strategy of doing options trades where we have a bit more flexibility and direction is working out a lot better. Because when you just go long or short stock, you either can buy it and hope it goes up, you can short it, hope it goes down. You don't get much though out of it. You either hope it goes up or you hope it goes down. And that's really all there is to it. With options, we have a lot more flexibility, and the flexibility tends to work out in our favor. So, the markets for the week ahead. And I'm filming this later in the day. I did make this earlier, though, at the market open. I'm filming this, though, later in the day because I wanted to actually pay attention to whether this gap right here would fill. And so, it's clearly not filling. I mean, I think we just talked about the S&P 500, but it's not filling, but I wanted to see whether that gap would fill. So, what trades do I want to go over? XLK. Right here, we're up 625%. I put an asterisk on that. Depends on when you got filled on it. If you got filled at a really good time with very little slippage, you could have easily made this a 10-bagger. If you got filled at a very bad time, bad trade location, bad liquidity, you probably only made 100%. This spread was moving very, very quickly intraday. But if we actually look at XLK, XLK got up to, and this would have to be 4 p.m. right here, 96.49, 96.49, and we were short the 96.5, so we were 1 penny off, and so we made a lot right there. 1 penny off, that turned out to be a very successful trade. QQQ, we put on a similar trade structure. It went up a lot higher though than we expected. XLK, it was right at the short strike. QQQ, it went higher than the short strike. It was more bullish than expected. That one we made 47%. And IWM, these are our, so last time, as I said, we had some bullish sectors and we had some bearish sectors. We said there was sector rotation where there were very bullish sectors like tech and then very bearish sectors like the small caps, like the financials, and so we shorted call spreads on those. IWM call spreads that we shorted, 10% profit. KRE, it's an insignificant profit, and I don't want to use KRE anymore because KRE is just not liquid enough for us to be using. So it would have turned out to be a very good trade if it was very liquid, but it just wasn't. XLF is more liquid. We made 10% on that one. Wells Fargo, so here's what I want to do. Buy back the credit spread portion, and actually, I was looking at this earlier in the day, but now Wells Fargo is up, so just buy back the credit spread portion of it. Initially, I was looking at Wells Fargo, and I was thinking we'll buy back the credit spread portion, then we'll take the debit spread and roll it down. I don't want to do that anymore. I just want to buy back the credit spread. I do not want to roll down the debit spread. And then with PayPal, it was essentially break even on that trade, and if you made some trade adjustments, maybe you came out with a small profit. Problem with PayPal is that on the butterfly right there, I was trying to find some liquid strike prices. The problem on the butterfly though was that the strike prices were too close together, and if we did something like a wide iron condor, which would have been a lot better further to expiration, would have given us more flexibility. It just isn't liquid enough. And so I was thinking at first we'll do a new opening trade and we'll try to do that, but it isn't turning out to be liquid enough. These are all the longer term trades right here. Nordic American Tankers, which is NAT, covered call, and EURN long calls, and TNP long calls. So here's how it should go. To not burn theta on this trade, what you should do is that on Nordic American Tankers, you should sell a call and use the premium collected to buy long calls on EuroNav and buy long calls on TNP. So you're selling calls on Nordic American Tankers using the premium collected to buy calls on EuroNav and buy calls on TNP. So that would be my suggestion to you. So you don't burn theta. Because if you just go out there and buy calls consistently, you're going to burn theta and you're not going to have anything left. SPY, 230 long puts, August expiration, just keep those going. It's a longer term trade. If you want to, you can turn that into a calendar spread or something I'll be alike. AG and North American Tankers pairs trade. So here's what we did. We said that there is a if-then scenario in the market. If the market finds the loose monetary and fiscal policy to be more important, and it finds the inflationary pressures to be more important, so if it finds those to be more important, then silver will go up. And so we bought AG. We said, if though the market finds the economic fundamentals to be more important and oil goes down, then Nordic American Tankers will go up. And we try to pair trade it together, where we said one of them is going to happen. Both of them aren't going to go down. Either silver is going to go up a lot with the market, or Nordic American Tankers is going to go up a lot because oil is going down, and there is steeper contango. Right now, though, it came to the point where North American Tankers, I would say that you made a small profit on it. With First Majestic Silver, though, on that, we're pretty much up over 100%. So First Majestic Silver, I believe I came out and First Majestic Silver was somewhere around right here. So somewhere around right here. And I came out and I said get some long calls on it. That has obviously paid off as it has gone higher. You probably would be up 100 and something % on those long calls. So I think that pair trade has worked out well right there. I want to keep it going though. Just try to lock in some of the gains on First Majestic Silver. Okay, so new opening trades. Moderna, short 100 shares, short the 67.5 puts. Everybody now in the market understands that Moderna is bearish. Everybody now knows that that what was going on with Moderna is bearish. Obviously, you can see the bearish price action. So what's happening right now is that the puts on Moderna cost a lot more than the calls. The puts basically cost 3 times more than the calls. So how can we take advantage of that? At first, I was just thinking of shorting naked calls when I first saw this. But then I said, okay, let's do a covered put because puts cost a lot more. Everybody knows that this thing is going to go down. Everybody knows that the news was very irrational. And so because of that, shorting puts on Moderna along with shorting 100 shares to take advantage of that through a covered put, I think would be a good idea. So I forgot to put the expiration right here. Go out though somewhere between a month and 45 days would be good, and short the 67.5 puts, and also short 100 shares. So that'd be a covered put right there. But I think that's good right there to take advantage of that volatility skew where puts are trading for far more than calls because the market has now realized and that what happened with Moderna was really just a big fake out, and that what fundamentally was happening was irrational. And so the market has realized that, and everybody's starting to bid up those puts. So you can go and short a put and short 100 shares with that covered put. Disney. So what do I think is going on with Disney? Disney came out with their earnings announcement, and it went higher, and it was, again, this was that irrational thing that I was talking about. With Disney, what's going on that's very irrational is that they said they're opening up their parks again, and the stock immediately went higher, and everybody treated it as though it was a good thing. So yeah, it's a good thing that they're reopening their parks, but that doesn't mean that it should have the previous valuation that it had, because even if they reopen their parks, nobody wants to go to a park wearing a face mask. Nobody wants to go to a park in conditions that are not ideal. Another thing you have to remember is that going to a Disney park can be quite expensive, and this is not just a coronavirus thing. This is a financial bubble. So this is a financial bubble that popped. And so I've been saying this, it's a pin that pricked the bubble. It's just a catalyst. But what you have to understand is that even if Disney parks are open again, are people going to spend money to go to a Disney park when you have 40% unemployment? And nobody's going to do that. Nobody under 40% unemployment is going to go to a Disney park. People would rather spend the money in a more conservative manner on something that they actually need, and that is not going to a Disney park. And so the market is just, it doesn't understand that. It doesn't understand the concept yet that it's just that it's a financial bubble and that coronavirus is just a catalyst. So I want to have some short call spreads right there. UUP, long straddle. So what's happening with UUP? UUP is a dollar index. I guess we can look at this on DXY. So it's a tightening range. Remember that volatility trades in cycles. So volatility will never just keep on going higher or never just keep on going lower. It goes in cycles, and it mean reverts. So after volatility goes higher and higher and higher and higher and higher, after volatility consistently just goes higher and higher and higher and higher, then eventually it comes lower. So right here, you had massive I'll use this right here. You had massive volatility right here where it whipped to the upside. So you had big volatility, then you had consolidation. And right now we're having the opposite happen. We're having a situation where the volatility has been very low and been very low for a long time, and that it should break out at some point. So and then on the other side, I'll just put another trend line. Okay, you're essentially in a range where you're tightening consistently. So it's moving a lot, and then it starts tightening. And what tends to happen is that after the market moves a lot, it starts to move less and less and less and less, and then it tightens in its range. And then right afterwards, it breaks out big time, and then it starts to tighten once again. That's just how the markets move. The volatility in the markets move in such a manner where you have extreme volatility, then the volatility contracts, and then you have very, very low volatility. Then the volatility expands, and then the volatility contracts, and it just goes back and forth and back and forth. We're in that contraction phase where the volatility was very big right here, but right here, recently, it just has not been moving much. So, that's why we want to buy the long straddle. A long straddle is a pure positive Vega play. So that's why we want to buy the long straddle, bet that that realized volatility will go higher than implied volatility. And what I mentioned right here is that I want to use for gamma scalping. So what's gamma scalping? Gamma scalping is pretty easy. Let me use a stock like Apple to explain what it is. So basically, gamma scalping is, it's where, so Apple's at 320 right now. If I bought the 320 puts and the 320 calls, so I'm going to buy let's just say it's a straddle. So I'm going to buy a straddle right there. When the stock goes down to 300, then what I'm going to do is that before my straddle had a call and a put, and both of them were delta 50. Now, stock's gone down to 300. Now, my call is maybe a delta 20. My put, maybe it's a delta 70. So now I have negative delta 50. So I rehedge my deltas by buying plus 50 shares. So I rehedge my deltas, and then let's say now that the stock goes higher. The stock goes all the way up to 340. So it goes to 340. Well, then now when it's at 340, my calls are now maybe delta 70. My puts are only delta 20. And so that means I have positive 50 deltas, and then on top of that, I own 50 shares. So what I want to do is I want to re-neutralize my delta. So now I'm going to sell all the shares that I already had. So minus 50. And then now I'm left with a positive delta 50, but I'm still left with a positive delta 50. So I want to re-hedge my deltas again. So now I'm going to short another 50 shares. So we sold the 50 longs that we had, and then we short 50 shares. So now I have re-hedged my deltas to 0. And then when the market goes lower to say $300, once again, let's say it goes lower to $300, what do I do then? Now I re-hedge my deltas and I get rid of these 50 shorts that I had, and then I buy another 50 shares. So then actually it's plus 100. What essentially am I doing right here? I am buying the straddle, but I'm not worrying about the straddle making money or not. I am simply using the straddle as a vehicle for which I can trade the stock around. So I buy 50 shares right here. It goes higher and it goes to 340. I sold 50 shares. I made $40 on each of those 50 shares. So that means I made $2,000. And then it goes down, and then I make money right there. And then let's see, from here it goes up back to 320. And then the straddle expires. Let's say a straddle expires right here. And then finally it makes one last leg up to 320. Now if you just bought the straddle and the stock went up, then it went down, then it went up, then it went down, then it came back, you would have not made anything because the price would stay the same. But when you gamma scalp, you are simply just using the straddle as a vehicle for which you can scalp the stock around. And so the stock goes up, or well, the stock goes down first, and then you buy 50 shares, and then the stock goes up, you sell those 50 shares. Then you short some at the top, then you cover it at the bottom, then you buy some at the bottom, you go back up. And so it's this buy low, sell high, short high, cover low mechanism that you create. And the straddle is simply the risk management, because if you buy some and then it just keeps on going lower and it crashes down, no need to worry for you, because even though it went lower, you still came out making money because of that straddle. So the straddle is simply the risk management vehicle for which you trade the stock around. That is what gamma scalping is. So that's what I want to use this for, is gamma scalping, is that I want to own the straddle because I think that I want to be long volatility. Gamma scalping makes money when realized volatility overstates implied volatility. And so it's in a tightening range. UUP is in a tightening range, keeps on getting tighter and tighter and tighter, and eventually the dollar index will break out. So eventually it will break out and volatility will expand. Realized volatility will be higher than implied volatility. And because of that, the straddle will make money. And if I trade the stock around the straddle, what I'm essentially doing is that even in a range-bound market, if I trade the stock around the straddle, I am reducing my theta decay by trading the stock around the straddle, because the amount of money I make from the trading of those stocks, from buying low, selling high, shorting high, covering low, will compensate me for the theta decay that I had on my straddle. So that's why I want to do that on the dollar index. If you guys have any questions about that, just ask me. It's a fairly simple concept. You just consistently buy the straddle, and then you just consistently re-hedge your deltas again and again and again. So it goes higher, you short some shares, and you re-hedge your deltas. Then it starts going lower, then you get rid of your short positions, and so you made a profit right there by shorting high, covering low. Then if it goes even lower, you buy some. Then from there, if it goes higher, then you sell your long stock that you had, and you made some money right there. So you're consistently scalping the stock. We call it scalping gamma, because gamma, I don't want to get too much into Greeks right now, but gamma and theta tend to travel together. And if you're scalping gamma, you're also scalping theta. Again, I don't want to get too much into Greeks on this episode, but that's essentially what you're doing, is you can reduce theta decay. Uber is one that has gone up quite a bit. From its bottom, it used to be at $13. So if you really want something to short, you got to short Uber. Uber was at 13. It's now up at 35. So if you want to short something, you got to short Uber, because this is the one that's going to crash quite big. It's going to crash 50% if the market goes, or more than 50% if the market goes lower. or if we get a second wave or anything of that sort. And it is part of the IPO bubble, I think. And this is one of the few in the IPO bubble that have not popped yet. So June 5th, 2020, short 39 calls, long 45 calls, or 43 calls, excuse me. So just doing call spreads right there. What's the next one we're looking at? Hertz, HTZ. Okay. So with Hertz, why am I looking at Hertz? Hertz has gone down a lot, and with the market capitalization of Hertz, I think that it's a possibility that Hertz has filed for bankruptcy. It doesn't mean the stock goes to zero. After a company files for bankruptcy, there is a very large chance that it gets bought out by another company, and that's what I think with Hertz right now. Hertz, you look at the balance sheet, is a garbage company, right? But I think that it is a buyout potential that we have. So I want to go long 100 shares. I want to short the January 21, 2022 two calls. So all the way out to 2022. Because after the company gets a buyout, all the extrinsic value of its shares are going to be wiped off. And so I simply want to go all the way out to January 21, 2022 and short a call over there. And you're going to be able to put this trade on for basically $30. It's not going to cost you much to put this trade on, even though buying 100 shares should be $284 because that short call covers it up a lot for us. So you have that right there. The risk arbitrage play, that's a longer term play. That's not exactly a fully guaranteed play. That's more, it's more of a nice flip that we can do if we're right, but we're not. I think that is a lower probability trade. Let's just put it that way. These other trades that we're doing, they're higher probability right here. It's more of a like 55% chance that we're right type shot, but it's a very cheap trade to put on. XLF, just continuation from last week. Short some naked calls right there. Just isn't enough liquidity to do some short call spreads. SPY, we had those gap fills, so I want to do a butterfly because we got the gap right here, So I want to take a look at doing, in case if gap does get filled, which the price action is telling us that it doesn't, but again, we don't know. So we can't put on a butterfly spread to just see if the gap would fill. And then KBE. So this is an alternative that I found that is very similar to KRE. It almost follows KRE step by step, but it's a lot more liquid. And we've been bearish on the banks for quite a while. They're the ones who are holding the bonds. The bonds are never going to get repaid, be subprime mortgages, so on and so forth. They're the ones who are holding it, and they never recovered from the '08 crisis. They are still in the same problem right now, but even worse. So right there, just some short call spreads. So those are the opening trades that we have. If you have any questions, just ask me. With the call spreads, our backup plan is to turn a call spread into a butterfly spread in case it starts going against us. Broken wing butterflies, although we don't have any broken wing butterflies, we do have a butterfly spread right here. I would like to sell something against a butterfly spread if it starts going against us. Although in the butterfly spread, you don't tend to risk a lot doing a butterfly spread like you do with the others. But that's just what I see going into this week and next week, is that I just want to put these trades on, see how those go. But we always have a backup plan. Our backup plan for the calls, or to turn it into an iron butterfly, for the naked calls to turn it into a short strangle, and to the butterfly, sell something against it, long straddle, we want to gamma scalp that. So just keep on doing those, and make sure you always have a backup plan in case you're wrong. But if you're right, even one trade that you're right on, like this trade, it can turn out to be very good for you. When it comes to the comments, like I said, I got this comment from Aaron, and I love when people comment. Please comment on the channel that we have. But the thing is that the reason I couldn't reply to this comment, and the reason I had to make another video, was because I couldn't see the comment on YouTube. I went onto YouTube, I went into the comments, and I could only see my comment that I commented on that video. And I'm not sure if you guys can see that comment or not, but what oftentimes happens with YouTube is that I post a that I get it emailed about a comment, and I look inside YouTube and I can't see the comment. So I'm not sure what's going on with YouTube right there. Oftentimes, also, I'll get notified about a comment that was commented 3 months ago, or other times I have to manually check and I see that there's a comment, and YouTube never notified me about that. So that oftentimes happens. So if you never get your questions answered, it's probably that I didn't get contacted, or that I did get contacted and it was late, or like this right here, I just couldn't even see the comment on the YouTube video for whatever reason. So if that's the case, that's probably why that I can't reach you guys, is because YouTube just doesn't notify me, or I can't seem to see uh, the comments, or um, it just never notifies me. So leave a comment down below if you guys have any questions. If I don't get to it, that probably means that YouTube did not notify me about it. I will manually check, but if I still don't see it, then just try and email me for the email for the YouTube channel, or go ahead and instead just go and comment it on the next video. Or if you're someone down there who sees that there's a comment that has not been answered, go and just re-comment it and say that the comment just didn't get answered, and that probably means that I did not get notified about it. Other than that, if you have any questions, go ahead and ask us in the comment section below, and we like doing this every single week. And as I said, follow along with what we're doing right here. Put your money where your mouth is, and get those large trades. And remember, one big trade can make up for quite a few losses, and that with these sorts of options trades that we're doing, we always have a backup plan, and we always have a way of getting out of it if we don't exactly know, or if we're wrong on market direction, we always have a way of getting out of it. Other than that, thank you for watching, and we'll see you next time.